So what I wanted to do in this meeting is to show you, what we are doing with my insurance company. And as you know, Buffett started that, and we copied him. And then we had Fairfax doing what Berkshire Hathaway was doing. And so this is what I'm doing now. So when you're looking at an insurance company, there are two things involved. One is one is the asset side, and the other side is the liability side. So on the asset side, you'll see a lot of investable assets, and that is where I come in. And when you look on the liability side, that's where you have reserves, claims, and so on, and that is for operating people. So I work on, so my job is to work on the asset side, on the investment side. So what I want to show you is like the results that we obtain. I didn't want to show as if like how I do the investments, like the investment approach, just to show you the results. So I'm going to start with that.
Can you just tell us how you thought about this? I guess so. You're just a value investor investing in stocks and bonds, and then suddenly, how do you think about this, and how do you think this will benefit you as a company?
Yeah. So what happens is, Professor George, you're asking a really good question. So what we have when you're managing an insurance company is that you have investable assets. So that has to be invested. So most companies tend to go into, let's say, treasuries, and there are no returns. You don't make any kind of money. So in the last 10 years. But if you know how to invest both on the bond side and also on the equity side, you can make a ton of money. So suddenly you have a company, a drab company, a kind of a boring company where returns are not adequate. But once you work on the investment side, it suddenly becomes a wonderful company. And one of the reasons why you can generate high rates of return is that normally in an insurance company, you have $2 of investable assets to $1 of capital. So if I make 8%, if I make 8% on investable assets, that translates to 16% on capital or on equity. So that's the leverage that you can use. And if they're making money, that is the combined ratio is below 100, then you're not paying to borrow that type of money. Normally there's a leverage there.
And you have what the combined ratio, so that you understand what the combined ratio is.
Yeah. So combined ratio is if the combined ratio is 100, that is break even. You're not making money on insurance. If it is over 100, then you're losing money. So if it is let's say if it is 105, then you're losing 5% on that $100 of premium. If it is at 95, then you're making 5% on $100 of premium. So below 100, combined ratio below 100, you're making money, and above 100, you're losing money. So that was the beauty of insurance, and something that Buffett first saw it and exploited it, and then we saw Fairfax being exploiting it by Prem Watsa. So this is what I'm exploiting it in my company, and the insurance company that I have is Stone Trust, and the holding company is Wintai. So what I want to show you, just show you the results first, and you can see how because of those results, the insurance companies have done really well over the last 4 years that I've owned it. So do you have any questions here?
Yeah, we just because the students understand, I guess, the concept.
Yeah.
So you're going to try to use, I guess, the float to make investments, right?
Right. Yeah. So what I can do is let me go to another page here. I'm going to get Austin here to show you the balance sheet of an insurance company. So
you can share your screen.
Yeah. Yeah. And so this is something I didn't put it on, but no, not that one. The other one. Yeah, this one. Okay, can you see this Stone Trust Insurance Company here?
Yeah, yeah.
Yeah, so you can see the assets here, right? On the asset side, you see total investments, 158 million at the bottom, right? And then if you go further down, you have cash and equivalent of 79.8 million. So when you add them up, it's close to $250 million if you add them all up, right? And then you look at the liability side. I'm going to go to the liability side. And if you look at stockholders' equity, It's at 140,974,680. You see that?
Yeah.
So that is $141 million, right?
Yeah.
But I'm working on roughly $250 million of assets. So 250 divided by 141 is somewhere around 1.7, 1.8. So that is where you get the leverage. So I just need to make 7-8% rate of return, and that translates to roughly around 14 to 15% return on stockholders' equity. So that's the beauty of an investor who owns an insurance company. This is where you can get the leverage, and you're getting it you're getting it without paying any interest on it, as long as your combined ratio is below 100. So for Stone Trust, the combined ratio for the year 2021 was 66%. So
Wow.
You can see we made tons of money on the insurance side, and we made tons of money. You're going to see it soon on the investment side.
So basically, so that you understand, I guess. So you get all these premiums.
Yeah.
And you invest these premiums, and you don't have to pay, I guess, claims whenever they happen in the future, right? So you get basically upfront money for free.
Yeah. So that is how you generate the float, Professor George, just like you said it. So so when you buy, let's say, a car insurance, you pay $1,000. But you don't have to pay that claims right away. Even if it occurs, it may happen a year from now or 2 years from now. And even if you do have an accident, it takes a while to settle that. So in the meantime, you have that $1,000 to invest. So that is how we call that float or investable assets. That is how it is created.
So there's two questions here, Max and Roshan. Max?
Yeah. Hey, Francis. Yeah, thanks so much for coming in. I think this is really, really interesting, just thinking about insurance float. I guess my question for you is, how do insurance companies differentiate on this current ratio? Like, how are you able to keep it at 66%? And is this something like that's sustainable moving forward? Because I feel like that would drive like the success of this company a lot.
No. So normally when we're looking at insurance company, as long as they're below 100, we are happy with it. So 66% is a really outstanding results. So something that I don't expect that to happen.
Mm-hmm. So do you think Stone Trust has some sort of competitive advantage in the insurance industry that will allow it to continue having this ratio below 100%?
That's a good question. Yeah.
Yeah, that's a really good question. What we have in Stone Trust is we have an outstanding claims department, and one ratio that is important is number of claims that are open for the business that Stone Trust is running. So Stone Trust has premiums of $45 million a year. The number of open claims is less than 300. So there was another company similar to Workers' Comp in Louisiana. So Stone Trust is located in Louisiana. There was another company where they were writing only $22 million of premium, but the number of claims open was over 600. So ours is 300, less than 300 on $45 million of premium, double the premiums, and our claims open was half of our competitor. So that's the competitor for Stone Trust, that one did not do well, so it had to go into a kind of a bankruptcy type setting. So our claims are really good. Our claims department is really good. They settled it really quick, and so I have to give credit to my claims department for doing so well.
So which part of you concentrate in Louisiana? Then what is your clients base?
We have clients are. Around 40% comes from Louisiana, and then we have other states that also contributes. But Louisiana is the biggest one.
So what's going to happen with another Katrina?
So we had something like that. So Katrina didn't affect workers' comp that much. When you go back to history over 10, 15 years. So we didn't have any kind of severe claims. The other one was COVID. Whether COVID would hit it, would really impact our business for Stone Trust. But most of the claims were nuisance claims, and we paid about $100,000, which was nothing. So COVID, we were kind of concerned that it may hit us. But COVID was more like a flu, and so we didn't get the claims that we thought we should not get. And then you have to prove it. You got it at work and so on. And if you get it at home or whatever, then it doesn't. Then you don't have to settle on that one.
Okay, Roshan.
Hi, Francis. Thanks once again for coming in. It's really appreciated by all of us. My question is a little bit more of a mechanical one, and it's about combined ratio. I was just curious, does the combined ratio of 100 already account for the claims being paid out? Or is like, for example, is your 66%, is that post your claims being paid out or pre? I just want to get a little context.
So we do it on an accrued basis. So it's claims plus all the expenses that goes with it, now and in the future. So combined ratio is made up of two things. One is the loss ratio, and the other one is the loss ratio, and then the other one is the expense ratio. Our expense ratio is around 40%. So then with a combined ratio of 66, then loss ratio was just 26%. So which is really good.
Okay, keep going, Francis.
Yeah. Okay. So next one, I just want to show you like what we did on the investment side. Now, investment portfolio, that is really important. So let me see, where do I go? Yeah. Okay. I'm getting Austin here to help me find out the sheet I need to go. Okay. So look at this sheet here. So this is the fixed income instrument, the bonds. So for Strong Trust, I manage both the fixed income instruments and I also manage the equity instruments. So this one is something that will teach you something quite important. We had a significant event, a negative event that impacted the bond market and also the stock market. It was a COVID, that in 2020 that it really impacted us. But a lot of bonds, went down to 50 cents. But when it went down, everyone was scared. And this is where, if you're a value investor, this is what is really needed. You need to have the guts to buy it when they are really, really cheap. So this is the fixed income instrument that I'm showing for March 31st, 2021. So if you see anterior resources, we bought it at 43.25, and at bond price as of March 31st, 2021 was 67.38. You can see Continental 50.5 went to 96.5. So the way we play the bond, we don't do it by just buying, like a 1% yield over treasury bills over, let's say, 10 years or 20 years. We are always looking for mispriced securities. So we are looking at mispriced securities, not only on the equity side, but also on the fixed income instruments. So if you go through the list, you can see like how much, like we really made a lot of money, not just on one bond, but almost the whole portfolio. You can see it. No one runs a bond portfolio the way I've done it.
So this were these distressed?
No, they were trading at 100 cents on a dollar, and then the COVID hit, impacted the stock market and the bond market. It went down. But because I've been in oil and gas for so long, I know the market, and I just bought some of these best companies, best oil and gas companies. And you can see how low the prices for some of them we got. Like Athabasca, we bought it at 22 cents on a dollar. You can see Continental is a big name. We bought it at 50.5 cents on a dollar, and so on, right? And not just one of them, but look at the whole slew of them, like how we really made money.
Mm-hmm. So, but I see the coupons, like the coupons are...
plus on top of it...
of zero, coupons like 9%, 6%, huge coupons. Like
huge coupon, yeah. So like, let's say like Athabasca, right? You're buying it at 22 cents, plus you're getting 9.88%. That alone is like 40% rate of return, 45% just on the coupon alone. And then we benefited from, bonds going up from 22 cents to 78 cents on March 31st. Right, and so on with a lot of other bonds. Same thing with Continental. The bonds went up from 50.5 to 96.5. So this is a lesson, to students who wants to go into value investing. Even in bonds, you can exploit the mispricing of these securities. Now on these bonds, there was one other thing that you all should take into account. It's something called PV10. It's one of those valuations you do for oil and gas. That what's the value of its oil and gas assets. So for example, like Antero Resource is 43.25. So if it went bankrupt, the price we paid was less than that, right? Yeah, less than PV10. So in other words, even if it goes bankrupt, we should get our money back for what we paid for it. We paid 43.25. So we felt confident that even if it went bankrupt, we should get 43.25.
Yeah, because I mean, like if I think back in 2020, all of this, no one wanted to touch the oil companies, right? Everybody was talking about ESG and they're going to kill all the oil companies. And you went against the head, basically. You said, I don't care what the consensus is. I think there's value in here.
Yeah. And you can see subsequently a year from now that you can see what happened. And we, really made a lot of money. But even if it went bankrupt, we felt at the price that we were paying for it, we would be safe. The price we paid for it, we should at least get that money back.
So how do you manage this? Okay, tell us a little bit about you. I guess. I mean, why you are so idiosyncratic? I mean, why you so like a robot-like, no emotions about the market? What makes you like this?
Yeah, so basically, I'm only concerned with valuation, and everything else is noise. So I don't listen to other people. What the market is saying. I don't look at all the bold headlines that you see in the market. Mine is just basically, if I'm paying $1 for it, am I getting at least $1 back? And most times, for whatever I'm paying for it, I'm paying $1 for it, I'm getting $2 back. And that is what value investing is. And you can see it, you can find it in fixed income instruments, plus you can find it in equities.
But for that, you got to be very careful to read every fine line, right? To make sure that the contract is well spelled out and what is going to happen.
Yeah. So you have to be extremely careful, and you want to make sure that like in the oil and gas assets, the oil and gas assets, even if it goes down, it is still below the ground. It's still there, and at the price you're paying. Let's say the cost of average price of let's say oil to get it out of the ground is around $40. And the price of oil cannot go down below 40 for a long time because that's below the cost of production. So every company will go bankrupt. So eventually it has to go up at some point.
Okay. Keep going, Francis.
Yeah. So this is shows how we are doing the fixed income, how we bought the bonds, and we didn't do it the way 99.9% of the market participants would do, right? So the next page is, I just want to show you, this is the price as of March 31st. But the next page, I think, will show you the price we actually sold it for. Yeah, so you see this price, all right? Antero, we went from 43, we sold at 67. But look at Continental, we sold it at 96. Occidental, we sold it at 101.25. Look at Athabasca, we bought it at 22, sold it at 100. Right, and so on. So we really, raked in big time here.
It's unbelievable returns, in the bond portfolio.
Yeah, bond portfolio. Yeah. So one advantage I had was because I've been in the market, in the bond market and stock market for over 40 years. So I've seen these type of scenarios before. So when it went down, I just went for it. There was no fear. So sometimes you have to go through it a few times to know, things will bounce back as long as you buy them below what it is really worth.
Yeah, that's another important thing, that you should have to understand. You need to understand the market in depth to make a decision, right?
Yeah. So there's a fine line between having conviction and you're right, and the other one is just being reckless. So there's a fine line, and if you know your stuff, know your valuation, then that is investing. But if you don't know your valuation and you buy them and they're like, if you think they're cheap, and then that is being reckless. So you really have to do your work and make sure you know your valuation accurately. Yeah. So this is on the bond side, and the other side I just want to show you is also on the equity side, like how we exploited it, right? Exploited the market during the last 3 to 4 years. So next page is the equity portfolio, right? And so this is the equity portfolio as of December 31st, 2021. So again, you can see we didn't just pick all the winners to put it up there. We basically picked all the stocks we had in the portfolio. Almost all, like the top, almost top 90% of the portfolio. And you can see, the big winners we had on almost all of them. Like to say, even some.
So from I mean, you used to be a pure Ben Graham investor. You're looking at the, bottom of the barrel kind of stocks. Now I see here you're becoming like a Berkshire Hathaway, because you have companies that are really large and with deep franchises, right? Like
Yeah,
Moody's and Apple and Alphabet.
Yeah. No, so you do have a point that Professor George, but in this case, what we do is value investing is just evaluating securities, and some of them that are growing in value, you have to put it value them differently. So buying crummy stocks, that are like mediocre stocks. The key thing is what is it really worth? If you sold it. But companies that are growing, you have to there's another valuation you have to put in is how much it's going to be worth 5 years down the road or 10 years down the road. Where would the company be? So some of the better quality companies, you're always thinking 5 to 10 years down the road, where the company would be, how much money they're going to be making. And based on that, is it really cheap? So if you're accurate in that valuation, then you can make a lot of money. So you can see we have some like mediocre companies like Resolute Forest Products. You can see we made a lot of money. It's $2 million, 2.179 book cost base, and market value was 10 million. And then you can see Alphabet. It's one of the good companies. $2 million was worth 11 million. So we made money all over the spectrum: good companies, mediocre companies, and some outstanding companies. So key thing in all of this is valuation. You have to buy them at 60% of what it is worth. And if you're wrong on your valuation, and this is really important, if you're wrong on your valuation, then you're going to lose money long term. So the component that that makes you a good value investor is how good are you in valuing companies and what is the intrinsic value. So if you're good in that, you'll do well. So you can look even at Stellantis. We did really well. That's Fiat, the old company. And 3.5 million went to 8 million, but they also paid $5 million in dividends in that 4-year period. You can see even with Apple, we did really well. And then we have another trouble company like MBIA. 2 million went to 5 million. Again, it was based on valuation. So I just look for anything that is where it's undervalued, and then I buy them, and has worked out really well over long periods of time, over last 40 years that I've been managing money.
Yeah, Jason, just a question, Jason.
Yeah, thanks, Francis. This is very, very interesting. I just have a question about, so like out of all the stocks, so like I know like on the stock exchange, it's like thousands of stocks. Like how do you find one that just like really stands out to you and something that you just really want to look into? What's kind of your criteria for that?
Well, first thing is, if you're buying good companies, you have to make sure certainty, how high is the certainty in terms of the earning power 5 to 10 years down the road, right? And that is really important. You cannot go on something like 50-50. You have to have like some conviction, like
but how do you narrow down, I guess, like you start from 1,000 stocks. How do you find, I guess, the 10 stocks that you...
Yes. Yeah. So you look at over the important thing is the last 10 years, how well they have done. And second one is capital allocation skill, which is really important. Like Berkshire Hathaway comes under the category of capital allocation skills. So we know what Buffett will do. I don't know exactly what he's going to buy 2 years down the road, but I roughly know the metric that he's going to use to to make his company grow. So in that sense, then I know Berkshire Hathaway will at least compound for at least over 10% a year, at least a minimum. Somewhere between 10 and 15%. So if you buy them cheap, undervalued at around 1.2 times book, it will work out really well. Alphabet, we bought it only around 14 or 15 times earnings 4 or 5 years ago. And that has worked out really well. Eventually went up to 30 times earnings. But if you buy it at 14, 15, 16 times earnings, that should work out really well, especially if it is still growing. But if it is not growing, has reached its limit, then even 15 or 16 times earnings is way too much. So if you notice, we never bought these companies, some of the best companies not in the tech area is like around 30 or 50 times earnings. That is too dangerous, because at 50 times earnings, you're only getting a 2% yield, like earnings yield, right? So at Alphabet, we are getting 7-8% earnings yield, but growing at over 20% a year for the next 5 years. That's what we looked at 5 years ago. Resolute Forest Products is interesting. We bought it at $3 a share, but $3 a share means that it's market value was at $300 million. But we felt that the earning power is at least $400 million a year in terms of EBITDA. So in 2021, I think the EBITDA was around $600 to $800 million. Just imagine that buying at half times EBITDA for a company. Normally you're paying 5-6 times. So Resolute went up to around $15, and that's, you can see how well we have done. And normally this type of scenario, buying below 1 times earnings, you hardly ever see it. But we saw that in Resolute when it got creamed 3 years ago. So when it get creamed, everyone is saying, oh, you're in the wrong stock, wrong. And they give you all these narratives about brilliant companies and all that. And they forget to see the valuation. And yeah, so with Resolute, everyone was dumping it, and we were just happy, buying them from them.
Russian.
Yeah, so I'm just sorry. Go ahead.
Yeah. So same thing with every one of these companies. You have to make sure that you understand the story behind it. And you have to make sure the numbers behind it, that you're confident enough, you have conviction. And it's not based on, not based on just what you want, but based on relevant facts that you can see it. So it has to be based on facts and not fiction, like whatever your or presumption, whatever you're presuming. So you have to be solid there.
Okay, Roshan.
Yeah, so I'm just curious about the growth side of things. I know George is big anti-growth, and I know in your past letters to managers, you did talk about how there's growth at any price investors and how they have like a large gap in their cranium or whatever. That was a good joke, but
that is from 20 years ago.
Yeah, I know. So I wanted to think of how has your mindset or framework for that evolved over time, and do you think about growth from a book value perspective, from an earnings power perspective, or from a multiples perspective? And how did you apply those frameworks to an Apple or a Lumen?
Yeah, so these companies, you have to be careful. They have to be established, right? And you cannot just buy any one of them. You can see if all the high tech stock got creamed. They're down 60 to 70%, right? And we have not got hit like that because we went into companies that have solid credentials. So that's really important. And the growth rate you're going to put for the future, you have to be very careful. Cannot be more than 20% a year for 10-year period. You know why? Because at 20%, money is compounding. Money is doubling every 4 years or less, 3.8 years or so. So in 8 years, that's gone up 4 times, right? And then 12 years, 4 times goes to 8 times. So if you're putting high growth rate, that means in less than 15 years, it will corner 100% of the market, 100% of the market they're in. And the world doesn't work like that. And so you're really careful, and you only want to buy these growth stocks where the growth is still there, more or less 5 years down the road, and you're paying not that high a multiple for it, like 14, 15, 16 times. But you have to be very careful in where you put. If you go wrong, where you're putting that growth rate, you're putting 20% a year or 30% a year, and then you want to pay 50 times earnings and justify it on 50 times earnings. The world doesn't work like that. So as long as they're growing around 10% a year and I'm paying 15 times earnings, I'm okay with it. That would mean that I'm getting an earnings yield of 7% on the current interest rate environment. Let's say 4 years ago was around 1 or 2%. So that was really inexpensive. But if interest rate goes up to, let's say, 6% or 7%, then it changes all the valuation, even for growth stocks. Then your denominator has gone up, and therefore your valuation will go down too. So when you're buying crummy companies, then you have to make sure the assets are really there. Are they really able to sell those assets, right? And so you're looking at something different. You're looking at some of the parts. Can they sell this? And therefore, it changes away from earning power to book value and the assets that they have, or hidden assets that they have, or assets that they can use to sell it and get cash out of it.
Yeah, I mean, in the past, I guess you were investing more based on the assets, and then you realized that the cash flows and the earning power was not there, right? And then you slowly moved into the Berkshire kind of quality stocks and growth companies.
Yeah. So what happens sometimes in the market is that if you're well versed in a different type of valuation, the market doesn't give you what you are strong at. So some years, the crummy companies are really cheap, and some years some of the best companies or the growth companies are cheap. So you just go wherever it is, but you have to upgrade your skill level at for different type of valuation. So I didn't do any bonds and things like that several years ago. Then 20 years ago, I started working on the bond market, and I became really good at it. So basically, yeah, I'm open to now buying anywhere that I think where I can find companies that are underpriced, whether in the bond market or stock market, or even in the stock market and equities. I can buy good companies, distressed companies, or really good companies.
So you think European companies are a good time to buy now with all this mess that's happening in Europe?
Yeah, you can buy some of them. But some of the best companies, they've fallen quite a lot. For example, like PayPal has dropped by 70%, but they are still not cheap. I would like them to go down even more. Facebook has got a big hit, and so you're just watching them. Facebook is most probably around the buying area or so, but you still want to watch it how the metaverse is going to work out. But they do have a huge cash flow being generated by the other businesses. Mm-hmm. So a lot of times, 99% of the time when you're in the stock market is just waiting and watching. That's it. Being inactive. You cannot be active all the time. So you're watching and waiting and waiting and watching. But at some point, the market will give you a really great price. And that time you cannot be waiting and watching. You have to act, and you have to act big.
So what do you think about holding cash?
Holding cash is, but at least you're not losing money, and when it comes, you can just go big into it. And that's what happened in year 2020. We had 75 million in cash sitting around at Stone Trust, and when all the bonds started dropping big time, we went big into it. We were not thinking then at that time. We just want to act every day. Every day we want to buy bonds. So right now in the Stone Trust portfolio, we have around $95 million in cash sitting around doing nothing. But that I could use it for acquisitions, or to buy bonds, or to buy stocks if they come down really cheap. So it's something, you need to have something in reserves, something to act. And that is what we are doing. Even if it is not earning anything, at least it gives us, the power to buy something when it comes down.
Okay. Is there any more charts here, or that's it?
Yeah, no, that is what I want to show basically in action. Like, I didn't want to show you something the way I'm going to do in the future, or how I buy stocks or something like that, but I just show you this is what I've done. And for guys that are in Professor George class, you can also do something like this, but you have to devote yourself to investment, and these opportunities come, and they don't come every day, every year, but every 4 to 5 years, you can get some great buys. And then when you see that opportunity, you should just grab it and go for it.
Yeah, Francis works by himself. He has no really analyst. But last year he hired one of my students, Tang, who is doing pretty well, right?
Yeah, he's doing really well, yeah.
So, yeah, I mean, you don't need like a whole team of analysts to help you. You can do it. Historically, he only did it by himself. And now he hired my student last year or the year before, I think. So,
yeah.
Any questions for Francis? So, Francis has only grade 12 education, okay? But he has the personality and the temperament of a value investor. And this is what you need. Okay, this is what you need. Now, Francis, maybe he's lucky too, because probably he inherited these genes probably of contrarianism. He was telling me that he grew up in India, and he was a part of a big family, and he had to actually go in the market and negotiate things with the vendors, right, Francis?
Yeah, that's right. Yeah.
And this kind of honed your skills, I guess, of finding cheap stuff.
Yeah. So what I was doing like shopping for my family. So I would go out to the bazaar and you haggle. You need to know what you're buying, and then you haggle for prices. And I found out when I came to Canada is that that is exactly the skill that is needed in the stock market. Except you don't need to haggle; you just have to watch those prices. But you need to know your valuation. You know what each of these companies are worth, and when it comes down really cheap, and it comes down if that industry comes down within your circle of competence, within your circle of knowledge that then you just buy them. And most of you have that temperament. You just have to translate that or transfer that to the stock market. Like, how many of you, let's say, buy stuff when they're at a discount, in the stock in the supermarket, right? And if you buy them at a discount, then you have that DNA in you, that trait in you. So you just have to translate it to the stock market or the bond market. So that's very simple, and that's what I understood when I was really young.
Alex?
Yeah, just kind of had one question about the insurance company that you bought. I think like different kinds of insurance companies can have like different, like I guess, amounts of like float relative to like equity, or like different criteria with respect to like how much you can like grow them organically and everything. So I'm kind of wondering, like, how do you settle on, like, I think it was Stone Trust as like workers' compensation insurance, like why that and not like life insurance or PNC or something else?
Yeah, so you have a really good question. What we are looking for is, for example, like PNC versus life insurance. Life insurance, if you buy into life insurance, it's tightly regulated on how and what you can invest. And unless we have some freedom to invest, then it's a lousy industry. So, for example, like even in this one year in Stone Trust, it was domiciled initially in Louisiana. We moved that domicile to Nebraska, and Nebraska has a Buffett rule, and they're much more relaxed on how much I could put into equities and bonds. Bonds, I mean, below investment grade. So that is key. So if you go to a certain state, even for PNC, if that state is tightly regulates what you can do in investment, then I'm not interested. Because if you just make money on combined ratio on underwriting profit, then it's you're just making 5-6% a year. But I want to make no more than 10 to 15% a year, and therefore you're looking for for the regulator in that state to be more lenient, or they look favorable towards equity investments and towards fixed income, like below investment grade. So that's a really good question. So you can see we moved from Louisiana to Nebraska for that precise reason.
Jason?
That makes sense. Just as a follow-up then.
Sorry? I didn't hear. Can you repeat? Who's talking? Alex, you're talking, or Jason?
Oh. Yeah, I had just a super quick follow-up with just like, do you think being like smaller scale is an advantage then, because you can get into like a more niche, like slightly less regulated piece of the insurance market versus like, I don't know, a Berkshire who, if they wanted to buy an insurance company, probably couldn't buy like a gigantic like workers' compensation insurance company? Like, is that kind of a correct way to think about this?
So like in my case, is limited by what I can buy. What I can buy is limited by the capital that I have. So right now we have $141 million in capital. So basically, I'm looking for investments around $50 million. But if you ask me if I had unlimited amounts of capital or more than $141 million, most of the good deals are around more than $100 million. Some of the $50 million, $60 million are companies. Most of them would be more on the struggling side. But you always start from somewhere. Like Berkshire Hathaway started with what, $14 million when he first bought into the textile company. Fairfax raised $9 million, initially in 1985, and that's from where you grew.
That makes sense. Super interesting. Thank you.
Yeah.
Jason?
Yeah, just a quick question about something you brought up earlier, Francis. Circle of competence. Like, how do we develop that? Like, so for example, like how do we get like exposure to like a lot of different industries so we can invest in those?
Yeah. So comfort factor is really important. So what you do is, like, when I was going into it, initially when I was young, I did not have that much comfort factor, and what I would buy. So I would buy a basket of stocks, right? So I would have comfort in terms of the principal. I'm just buying a whole basket of them cheap. So that is called shotgun type investing. You just spray everywhere. You have 20, 30, 40 stocks. But as you get older, you will find that not the certain areas that are your strength. Then you go rifle shooting. You can go like each stock, I'll buy more of it. So as you gain more confidence, and that confidence also built on success in the past, then you will say, okay, this industry is I'm going to be really good at. I'm really good in forest products, or I'm really good in consumer products. And that is where you concentrate. It's the same thing in sports. You can say I'm really athletic, blah, blah, blah. But as you get older and you play different sports, you can say, okay, it is in this field. Let's say basketball. I'm exceptional. But if I play volleyball, I'll just be average or above average. Or if I play badminton, I would be above average, but not excellent or outstanding. So that you want to go to a field where you will truly excel, where you will be outstanding.
But do you what you read about industries? How do you develop the skill in an industry? You read a lot of materials?
Yeah. So I found that when I was young, it took me 6 months to a year just to understand one industry. You won't get it just from 1 to 3 months of reading. You really have to be in there. And then it takes 6 months to a year to really understand an industry. And even then, you have to keep honing your skill. You could be in an industry for that period where it was really hot, really going up. And then you have to also go to a period where there's a downturn. And so I remember when I first came to Canada, architecture was really hot at that time. But 3 years later, there was too much overbuilding, and most of the architects that were there was a hot area to get into in school. Most of them, then you had an oversupply of architects. So you have to go to the downturn and upturn and downturn to really understand the danger of being in an industry. Same thing, let's say, in terms of you're talking about choosing this industry to go. But when I was young, I also had to make a decision on where I should concentrate my skill level. So I found out that although I was good in math, and all my classmates were going into engineering because of that, I found out that if I went into engineering, most probably I would just be an average student or above average, but not outstanding. And then with Oriental parents, they want you to go into being a doctor and so on, right? And that's where and also my other classmates were also going into medical fields, like being a doctor. But I felt that that field I would just be an average or above average. I would not be outstanding. I figured it out really early on that my best bet was investments, but I had definitely a competitive advantage over a lot of people just because of my background. So even at that time, going into investments was really a negative thing because the stock market did not go up for 20 years. You all lost money if you were in the market for 20 years. But I felt that was my field. That is where I have a competitive advantage. And I just went there, regardless of who I was said, my peers was doing, or my parents were saying anything. That is where I would excel. So so even for students, you all have to, make that type of decision where you are going to excel, not just being average or above average.